All right, everybody, welcome to Cyber Bulls. This is a show about Tesla, and it's a show about different investment styles. Today, we have a very special guest. It's Gary Black. He is a managing director of the Future Fund, which is a kind of investment advisor firm focused on investing in growth companies. We have Alexandra Mertz. She's known as Tesla Boomer Mama, but don't be fooled. She's an ex-fund manager and a force to reckon with. Later the show, she'll be doing a special segment on the Chinese export boom. We've got Jeff Lutz. He's an ex-supply chain executive working at several Fortune 100 companies like Google, Lenovo, and Motorola. We've got Xander Sky. He's known as the Froyo King. He owns 4 frozen yogurt restaurants. He's now a trading extraordinaire. Keep an eye out for his YouTube channel. He's going to be launching shortly for options trading. And we have Christian Valente. He's a ex-financial advisor. He's now a retired bull. He's now just trading for fun, but his approach of momentum trading is sometimes frustrating to us long-term Tesla bulls. So one of the very first topics we want to cover today is a lot of us are starting to get a little bit more bullish on Tesla. Let's discuss why we are doing that. And I know that's why we brought Gary here, because I think he's starting to become much more excited, especially with the Fed turnaround. Let's hear more about his opinion about that.
So we're bullish, and anybody who thinks we're not bullish, they should just look at our ETFs. They can see that Tesla's a big position. It's our second largest position, but we've been bullish because we think that gross margins are bottoming. We think that the third quarter, when auto gross margins ex reg credits specifically, they were 16.3. We think that that's the bottom, and as long as Tesla doesn't try to cut prices some more, which I don't think they will, maybe around the margin, like on inventory and stuff, is fine. I think that will hold. The second reason that we're bullish is because we think this narrative that has somehow appeared in the media the last couple of weeks about EV adoption stalling, we think that's easily refuted, and there's data, and we'll be publishing it on Monday, that shows that EV adoption in the third quarter was actually higher than second quarter. So this narrative that because GM and Ford are pushing back their EV expansion plans, and because some of the suppliers like ON and Panasonic, have cut back on their needs, people jump to the erroneous conclusion that EV adoption has stalled, and that's not true. And the third point, to your point, Herbert, is as interest rates go down, and we're starting to see that almost in dramatic fashion, because inflation's coming down and economy is cooling, that helps long duration, meaning high PE stocks, where all the valuations in the tail the most, because you're taking that tail cash flow or earnings and you're discounting at a lower rate, and then mathematically that means it's worth more. So all those things make us feel better. And of course, we're getting closer to the Cybertruck launch, which will be in a few weeks, and the Model 3 Highland launch is already happening as we're sitting here. And I do think that as we get to the beginning of the year, when you get the $7,500 credit off invoice, all that is good for Tesla.
Okay. Yeah. One of the topics we'll cover later is when the Fed pauses and then maybe even pivots. I'm telling you, we're starting to hear the pivot conversation coming up soon. We'll find out how that might impact Tesla and when it might impact Tesla. But let's go around the panel here. Let's start with you, Alexandra. What's your thoughts on your bullishness on Tesla right now?
I mean, I've always been bullish, but I have actually 2 questions to Gary, if we could go back just a second. One is, I mean, I know Tesla is your second number 2 stock in the fund. Now, two questions. A year ago, it was 11 and something percent. Now it's 6 and something percent, so roughly half. Both times
good thing
being.
We did that, right? It's a good thing we did that, because
exactly. I think. Exactly. And so my question from that comes, you've also cut about 10% of that position just before the earnings. I think it was on 9th of October. So are you, I mean, I know you can't give really precise future statements, but are you today in a position where you feel you want to build that back up? I mean, no doubt about it that you saw it, right? There's no doubt.
Look, long-term, short-term. Long-term, we're a believer that as EV adoption continues to go to, globally, to 60%. Today it's 12 at the end of the third quarter. The fundamentals are huge for Tesla. My issue is short term, that I don't want to be in the stock if they cut price again. And if I could get conviction that Elon would get some discipline and stop cutting price because he's getting no volume from it, then I would take the position up to 10%. But I just don't know if he's going to act rationally. He hasn't acted that rationally this year. And if he cuts price again, because seems to be the only tool they know how to use, then the stock's going to keep going down. And so I don't want to be getting in the way of that. I think most of the institutional PMs I talk to, they share the same sentiment I do, that if they're going to keep cutting price and getting no volume as a result of it, then it's hard to be in the way of the stock, because then you get earnings revisions. We've got 2024 estimates now at 402. They're down about 40% from where they were at the beginning of the year, because it keeps cutting price. Again, if you could get volume back as a result of that, then it's all good. But they haven't gotten any volume growth as a result of that. So I gotta get more convicted, more convinced, I guess is a better word, that we're not going to see
Not
more
convicted
price cuts.
now.
Yeah, I mean, price cuts are not good, and people who think they are, if you could get volume growth from it, that's great. But they haven't gotten any volume growth from their price cuts.
Okay, so that means you are comfortable at the
I'm waiting.
6.5%. Okay, got it.
I'm waiting.
Thank you.
I'm waiting to see that the price cuts are over. That's the short answer.
Okay, Alexander, you can answer the question first, or?
But, well, I mean, you asked me whether I'm more bullish. Difficult to be more bullish than I ever was, given that I have just, I don't have a short-term vision on Tesla. I have a medium to long-term vision for it, and that is completely intact and even reinforced with all the publications I do all day long. You know about that. It's the bot, it's the energy, and that's obviously also the car market. And while I've seen the car market, that we're coming to a stage where competition is moving up, whether to take it seriously or not is another question. But I mean, I follow all that, but that doesn't hinder, or that doesn't bring my conviction on Tesla down. Now, it is true that if we're getting into a lower interest rate environment, and now there seems to be 3 to 4 cuts in the market for next year, which may be exaggerated on the other end quickly. I mean, but that's the way the market is, right? Always too much in one side or the other. But if that is the case, obviously Tesla is the stock to be in.
Yeah, I feel the same way as you. I don't think it's exaggerated. We'll talk about that shortly. Let's go right to Jeff.
Yeah, it's interesting. This whole. I like to take a different angle on this whole thing regarding volume and price, and asked really the audience, maybe even Gary too, back to you, because we kind of debated on this a bit. But how do you put a price on the capitulation of your competitors? Because it started as unannounced capitulation, basically them underproducing volumes throughout the year, because the more volume that they would have produced, the actual higher their losses would have been in their segments. They would have actually started eating even deeper into their ICE profits. So you have to think, I would challenge the no volume growth, because I don't know what Tesla's volumes would have been if Model 3 was over 40,000, 45, 50,000, and Model Y was in the 60s. What their volumes would have been. I understand the point of, they came into the year with 1.8 and they're leaving the year with 1.8. I understand that point, but now you have to think ahead to 2024, and this is what I hope PMs are thinking about. Is you go into 2024 and you go into 2025, and now Ford and GM have gone from this unannounced capitulation to announced capitulation. They've said that they haven't figured out EV. They don't have the economics right. They've been on the record now, and now they're not putting their capital against it. Ford announced a $12 billion halt on capital. GM announced multiple models pushing out, and that they're not going to hit their 100,000 units in this half. And now you look to now here's the thought experiment. You look to 2024, and we're going to leave. Let's just focus on the U.S. for a minute. We're going to leave the U.S. probably with around 1.3 million EVs, built and sold into distribution this year. And the SAAR, the total auto market in the U.S., is around 16 million units. So, roughly 8%, maybe a little bit higher. We'll see what the adoption rate is. Now, let's go back to Gary's metric on adoption rate for next year, and it getting to maybe 12%. So now all of a sudden that 1.3 million units is closer to 1.9 to 2 million EVs. Who's going to build those EVs and ship them to customers in North America if the two main competitors have capitulated? who's going to actually do that? Now, that's not a zero sum. There's Hyundai and so forth, but there's the vendor or the OEM that's in the best position to ride that EV adoption curve and to fill those orders is Tesla. So you have to think about the price cuts. What they did, they crowded out the competition, and it's actually has given them the opportunity for this volume boost in 2024. So just like to kick that thought around.
So you want me to answer that?
Sure.
Mm-hmm.
So I don't think they've capitulated at all. I think it's just a case of short-termism. You know, this is the budget season. This is when they review budgets for next year. And I think they've probably been told they can't run, you know, whatever their profit number they presented is. So they've been told to cut back on their capital spending. That 12 billion was not, you know, today. It's over the next several years, as you know. And so they'll still be able to produce. They're still going to produce EVs. Their factories that they have today are still producing EVs. And so I think it's just they're hoping, as you pointed out, and you're correct on this, that they can come up with a better manufacturing process so that as they expand in the future, they can compete with Tesla. But I don't think it's going to affect them in the short term because they have lots of inventory and they have lots of capacity right now. But so come next year, I don't think there's going to be a shortfall in quote unquote production. But I think if they continue to mothball, for lack of a better word, their production capacity and they can't come up with a cheaper way to make cars, then you're right. Then Tesla will be the ones filling the volume, particularly if they continue to expand. But I don't think it's going to affect them for next year, for 2024.
Oh, I do. That one I'll take the other side of. So first off, from a design timeline perspective, they don't have any other products in the pipeline that they would actually be able to ship. We talked about this thing, Gary, of like, why aren't they discounting what they have to move the inventory? The answer is they have nothing to actually jump to. It's number one. So they're not going to take the Ford F-150 and pull $10,000, $15,000, $20,000 out of it, or they're not going to take the Cadillac Lyriq and pull $10,000. They're not going to be able to do that. These cars are designed fundamentally flawed from a unit economics perspective. They're not positioned at the right price point. They're positioned at a price point they thought would have been successful. Tesla changed that. So I still come back to the U.S. auto industry has to go from about 1.2 or 1.3 million units to almost 2 million units. And Ford, I would disagree. Ford doesn't have the capacity. They don't have the actual capacity in place. And now they said that they're not going to spend because they said they were going to be at 600,000 unit annualized run rate at the end of this year. And it looks like there's something closer to 150 to 200,000 units.
That's demand. That's not supply. People aren't buying their trucks.
Well,
and we can
but
get into
the
this.
more they build, the more they would lose. This is the flywheel. The more they build, the more they would lose.
Yeah. Look, you guys have been look, in my view, you've been overly optimistic about Tesla all year. You know, you and Herbert and Alexandra. And I think, again, don't use the word capitulation. They're being told by their board to not spend as much money. That doesn't mean they're going to stop producing EVs. They're just being told they can't lose much. You're right. Ford's losing $36,000 per vehicle every time they produce. And what the board is saying is you can't expand that until you can come up with a better way of producing so you can get the cost out. You know, Chevy next year, GM, you know, they will have an Equinox EV. They've talked about a $35,000 vehicle. And as you guys know, what they've been saying is, well, we'll get the $49,000 vehicle out and we're going to hold back on a $35,000 vehicle. So you're still going to have EVs to sell. And so will Hyundai, and so will Kia, and so will Mercedes, and so will BMW, and so will Volkswagen. So I just think this narrative that you're putting out there, which again I respect it. I just think that nobody's going to be able to produce EVs because everybody's cutting back. I think that's a false narrative.
I didn't say zero. I didn't say who's going to grow from the 1.2 to the 2 million. I don't see them growing meaningfully, but we can leave it there. We're kind of going back and forth.
But there's a ton of inventory out there, Jeff. I mean, there's a slew of inventory today. You know, and there's still production capacity for EVs out there when you add everybody up. And I wouldn't just think about the U.S. Think about it globally, in Europe and in China as well. And as long as EV, my metric is EV adoption defined as battery EVs divided by global SAAR. If that keeps increasing, and that's a demand metric more than a supply metric, then I'm going to be bullish on Tesla. But I'm not going to go overboard and say, well, Tesla is going to soak up all this volume that Ford and GM are not going to make, because I don't think that's going to impact their short-term numbers. I think you're right. In the long term, if they don't come up with a cheaper way to produce EVs by, what did they say, 2025? What was Farley talking about? Gen 2, Gen 3? I think he was talking 2025. Then you're right. Then then Tesla really can push the accelerator, but I don't think it's going to affect them next year.
But don't you remember GM promising us for end of 2023 30 models? Don't you remember? I mean, every year. So they're not coming there. They're not getting there. They're not producing. They're not having the technology to do it. And in the end, they will have two choices: either find tier 1, tier 2 providers who help them build it so that at least they don't lose as much money on it, and not do it themselves anymore. And one of them could be Tesla, or just, and I think that's what they're trying at the moment, just hope that hybrids fill the gap for as long as they need. And I think that's actually a sad statement. I just did a tweet about that this morning. I think we're actually letting them slip into this hybrid world, which eats potential Tesla buyers as well. The buyers are not educated enough. So for once, I join you on that one. They're not educated enough, understanding that hybrid is not what they're hoping for in terms of stepping into a sustainable future. And Tesla is not making that clear enough. And GM and Ford and so many other are using that window to promote their hybrids where they are still making margins.
And I agree with that. And look, we've seen Toyota do that, and Toyota's been very successful at pushing their hybrids. I agree with you. If GM and Ford had their druthers, they would step people slowly into the hybrid space, and it gives them some time to build, a cheaper, we'll call it Gen 2, Gen 3, using Farley's wording. They can come up with a cheaper manufacturer. But so it's kind of given them a little bit of a pause so that they can come up with a cheaper EV. But in the meantime, you're right. They're going to be pushing their hybrids. And and this is the punchline, because Tesla refuses to try to educate people on why they should go to EVs, they'll probably be successful at selling hybrids, because people don't know. To go from, gas-powered engines, which is still, let's call it 90% of the market, to EVs, there could be a step in the middle. And if GM and Ford could convince people to buy a hybrid instead of going all the way to an EV, they're going to be happy, because they're not going to lose as much money. To your point, they still make money on hybrid, or they lose less money. Let's put it that way. And that's the problem.
Exactly.
Tesla has to think more long term. And everybody says, well, they think long term. They don't think long term. When they're cutting price by $2,000 or $3,000, it's a promotional narcotic. You're getting a short term pump to volume. And if they thought about, how do we get these non-EV users into our franchise? Because once you go EV, you don't go back. And once you buy a Tesla, you don't go back. I just think they got to be thinking longer term about how do they capture an EV customer, and then how do they capture a Tesla customer, and not rely on discounting by $2,000 or $3,000 to make their numbers for the quarter, which is just silly. It's silly behavior, and I wish they would think more long term about it. But it's neither.
Well, I wish there would be less. I wish there would be less lobbying in the United States for hybrids, but I mean that's just a given. And so we'll have to work around that and make sure we get the message out.
Why wouldn't people argue that they should educate people on the benefits of EVs, and don't let GM and Ford sell hybrids? Because hybrids are not really EVs. I mean, they are, but they still have a combustion engine. They still require gas. So why would you even give them an opening? I don't understand Tesla's behavior on this one.
Go ahead, Xander.
Do you think, Gary, that collectively the other manufacturers and legacy, that they have to kind of stick together, since they've all been lapped multiple times, and there's no way that they can go for first place. So it seems like they have to all decide to not move forward or not. Do you think that that's like a strategy, or?
I don't think it's a strategy. And look, the Chinese, and Elon has said this many times, they are so far ahead of GM and Ford. The latest EV share I saw in China was 23%. I mean, it is so far ahead of where we are in the United States. I think GM and Ford and Stellantis are sticking together, but I don't think the Chinese are on the same page. NIO and XPEV and BYD and Baidu. I mean, I think they're dancing to their own beat. And I think there's enough pure EVs out there, whether it be Rivian or any of the others that I think that's a dumb. Let's put it this way: if that is the strategy, I think it's dumb. But I do think Tesla's given them an opening by not trying to educate buyers why they should go full EV. And I think that would just be from my standpoint, it'd be long-term thinking. But Tesla doesn't do that. So it's shame on them, and they're giving GM and Ford an opening because to Alexander's point, they will sell hybrids as long as they can get away with it because they lose less money and they may actually make money on hybrids. I don't really know.
I'll jump in real quick. I like everything being said so far, but what I'll say is I look at it a little bit differently, right? So just a little bit of a background. I was in Tesla in a max position from 2019, ran most of it up, but I've changed my philosophy now. It's one position of many, meaning, and we've been talking about this all year. I thought the stock price wouldn't do much because the stock's not going to rally on earnings cuts. So earnings was $6 at one point this year. Now it's like closer to $3. So I don't really look at all these specifics. So, at any moment, Tesla could come out with something, some breakthrough could happen, and the stock would rally. But fundamentally, I didn't think Tesla stock price would do much this year. And I've kind of called it right because there's just no earnings power. And when you're slashing price, I understand it from a business perspective, but I look things more of a stocks perspective. And we're a stock show. So, when we talk about Tesla stock, I'm not in a rush for anything because, we're in this macro and they're doing great. The business is executing. But for me, there's so many other businesses that are doing so much better. And there's so many businesses that are being mispriced. And the value has not been taken out of the business because it's either a small cap, which have been decimated. There's so many opportunities out there, such as, we can go into some companies later, but I think Tesla's story is well known. We know what units are due. You could drop down the operating margin and you get earnings. The earnings are going to be flat and they're probably not going to really accelerate into next year unless you have one of these breakthroughs. So we could talk about car demand, this and that, but at this point, the story's known. So expecting Tesla to go to 350 or 400 in a short amount of time, I just don't see it. I could be wrong, but just the earnings aren't there, and the momentum in this environment is not there on a basis. So I love all the talk, and I know everyone is very big into Tesla here. I am very big. I love Elon. I love everything he's doing with X. I love the free speech, and I love Tesla, the company, and they've done a lot for me in my personal life. But right now, it's a story that I think is kind of just on hold. And it needs another year or two. In the long term, it could be a great story. But I think medium term, there's not that much excitement right now.
I want to jump in because, you said something like earlier that we are a stock show, which is true. We talk about Tesla stock, but we have different investment styles, right? So you are a swing trader. You called yourself. You're a momentum trader. You go in and out. I am bullish on Tesla, and one of the styles that is proven to be very, very successful is the buy and hold style, right? Where you pick a very once in a generation company, and it's going to go through its swings because it is very volatile, because it's a story stock. And so continuing to focus on Tesla and earnings is what tells you what the price is going to be. That is a tried and true method by people like you and Gary and others. But obviously, my method, which is what a lot of people do as well, is earnings will tell you something, but they're not the full story, especially for Tesla. Because Tesla is a car company, but it's also got 4 other startups that are pretty massive startups. And so for me, yes, I get you. This is the price it is. It's probably going to be flat for the year. I'm willing to wait it out, but I'm not going to go and trade in and out because that is just not my preference. It's just a different investment style, right? Go ahead.
And fair enough. Go ahead, Gary.
So if earnings, which are for $4 for next year now, and they're down by 40%, if I were to tell you that they're going to be $2 next year, which means the stock will probably get cut by half. So a buy and hold investor such as yourself would hold on. Is that true?
That is true. That is true. So, you're correct. If earnings fall, price will fall. But this is a story stock, right?
It is.
So this company's not going to go down, and it has at any moment the chance, I believe, that one of the stories kicks in. Okay, all of a sudden they show an AI an AI solution that's going to be revolutionary. They show FSD is now working. They show a demo of the bot. There's so many things that they could do because of this innovative company. And so you're right. If you just think of it as an auto company, which you can argue it is, 90 plus 95%, I guess now, 91% of the revenue is on auto. You're correct. But that will change very quickly. So I'm very comfortable just hanging on.
Yeah.
So why
And your
wouldn't you,
approach
if
is great,
if-
Herbert. But what I would say real quick is that approach is great, but Tesla stock's been nowhere for 3 years. Like if you like, so it's fine to be buy and hold. So, but my strategy, and again, everyone out there, this is not financial advice. I'm trying to particularly compound money. And every year that goes by, I want to compound and snowball it. So if I'm just in one stock and that stock's going nowhere for 3 years and I didn't add any new money to it, I'm nowhere. So the way I do it is, keep Tesla as a position, maybe a nice size position, and leave it there if you don't want to miss the moves, and it's hard to time it. I get it. But in the meantime, there's other stocks that through research, and if you're good at it, I'm not saying this is easy, but I've been successful at it, and so I keep doing it. So I go through and I see companies that are undervalued, and I look for momentum. And you can compound in the meantime while you're still waiting on Tesla. Now, if you just want to be a buy and hold Tesla investor and you're going to hold it for 10 years, that's fine. But again, and I've said this a million times on this show, if it doesn't work out and you have all your eggs in that basket, that's going to be very painful because you're not getting any of the market growth. If the S&P's up and Tesla usually outperforms the S&P, so I'm saying that might be a great investment, but it's still one where you're depending everything in one entity. And again, for a lot of people that have all the retirement in there, that's just a lot to do. So I get it. And, I've been successful kind of doing that also. But at some point, I think it's prudent to have a bunch of bets if you're not following it, maybe just own an ETF. But I get you, Herbert. Everyone's different.
Okay. So I want to absolutely clarify. Every person has different scenarios, different stages of their investment style. Let's get that straight. Number two, when we say I'm all in, you have to actually figure out what you mean by all in. Okay. I've already mentioned this many times. It doesn't mean I don't have real estate. It doesn't mean I don't have cash. It doesn't mean I don't actually invest in other stocks as well. It means that vast majority of I've moved into this one stock. But it's absolutely perfectly great if you guys want to take certain percentage of that and invest, which I do, right? Like you can play around the edges or try to time the market for sure. But if you're telling me that you're going to take your entire basket, your entire fund in Tesla, and I'm going to go to zero, then I'm going to go back to 100, then I'll go back to zero, that's ridiculous. Don't do that. Now, you can do it if you think that you can beat the market and time the momentum and figure things out, go for it. But the vast majority of people fail. The famous report that came out showed that when they looked back in the last 10, 15 years, the people who were dead had the most highest performing than the people who are trying to time and do that kind of stuff. So, that's just facts.
That's true.
Herbert,
Absolutely.
can I ask you something though? If you go back to my analysis, so if you said, I know they're going to keep cutting price and therefore earnings are going to keep going down. I don't care about that in the short term. If earnings go to $2 for next year from $4, and I don't care if the stock price goes down from where it is today, 220 back to 110. If you were to sell today, because you know that because you've got a lot of information about Tesla, you could get twice as many shares, and you'd have twice as many shares when the stock gets 110. And that's why I don't understand why even buy and hold folks say, you know what, if they're going to keep cutting price, which I know is going to cut their earnings, I might as well sell now and then buy it when they stop cutting price. I don't understand.
Yeah, it sounds like you're saying that you can predict the future, Gary. And so it's 200 now. I think it's going to fall to 100. I'm going to go ahead and sell everything because isn't it great if I can buy it at 100? I'm going to get double my money. I'm going to do that because I know it's going to fall to 100. Great. But I'll tell you what most of us do, which is we keep our fund where it is now. When it falls to 100, we buy more. Doesn't mean that we going to try to time it. Now, some of us may, again, there's nothing wrong with doing what you're saying. I'm not saying don't do that. I'm not a zealot going, no, you must not do that. I'm just saying that it's just okay if my time horizon is like many is 5 years, 10 years. And so I'm going to close my eyes and I'm going to wake up 5 years from now. And I know that this company is executing. When you said earlier in this call that, that you guys called it right with the Tesla stock falling and so forth, That's true. But if you, again, I know you didn't mean to say this, but the business fundamentals for Tesla is more positive than negative. You might say during the earnings call, oh, there was a little bit of a, slowdown in Cybertruck, slowdown in 4680, slowdown in semi. Those are all true. But at the end of the day, they are hitting it still with 1.8 million cars at the end of the year, right? They're launching the Cybertruck. They're already starting to build the Gen 2 platform. The companies that are out there, they're all bringing back their forecast for EVs, which is what Jeff is saying is going to open up the market for Tesla. Things are still looking good long term. And I know you agree. The bot is progressing much faster. Alexandra did a fantastic service in the last several days where she was tweeting out all the hiring that Tesla's doing for the bots. And we're talking about multiple shifts even over the evening. So, I've been saying this for the last month. You guys have been hitting me about how the bots is not till 2 to 3 years from now. It's now. It's coming out sooner than you realize. And I can go on and on. Of course, FSD 12 is a brand new that now by all accounts, it looks like it might actually be the step change required to get us closer to robo-taxi. So now I know you guys are looking at it from next year. I don't look at that. I just say, hey, 2, 3 years from now, we're going to be just fine. And even if there's now the macro, let's get there. It's the macro that's causing the stock to fall. If the macro changes, which we're now hearing that it's about to turn, if this changes now, it doesn't matter if the earnings is 2 or 4 or 6, because the PE will go up because people will be able to buy. You, Gary, had a fantastic tweet just 2 days ago. You said that when the macro changes, the interest go down. It not only has a double whammy impact for a growth stock like Tesla, right? Not only because now more money will flow into growth stocks, but Tesla itself, because of interest rates for car buyers, will go down and there'll be more. So that is now signs are pointing. So that's the one that really I've been waiting for, is the macro to flip. And so this idea that, oh, we're in a recession, sell everything. And now we're in a boom, buy everything. That's proven to be the wrong strategy.
But I'm not advocating
you hold
that.
for the recession. You hold
that.
for the recession. Yeah, I know you're not. I'm defending myself.
I'm not looking at the stock price and saying you could predict the stock price, but the fundamentals. I disagree with you. The fundamentals are better today than they were a year ago. They're not. They're worse. Margins are down by half. They're worse. They have to be worse. If the margins have gone 26 to 16, and all the other stuff you said, that's all rhetoric. That's all promises. We haven't had any evidence. We know what Elon says, and we know he blames the economy, but we see that, for instance, payments are actually lower today than where they were a year ago. So I just don't accept the premise that every investor thinks the fundamentals are better today than they were a year ago. They've made some good long-term investments. You're looking at rhetoric. You're not looking at numbers. You're looking at what he says. You're trusting his words.
If your definition of fundamentals is margins, you're correct. If your definition of fundamentals is volume, then you're not exactly correct. The margins is fallen from an artificial high to a pretty damn good margin for an auto company, okay? It's just that you're comparing it to where it was because of the supply chain, because of the artificial scenario, and that's why you're upset that the margins fell. For a car company having 17, 16% auto gross margins is through the roof amazing. And then you look at the operating margin, which is amazing for a car company because it's not a car company. They are investing in multiple businesses, as you know. And so for me, it's like every single day that progresses, the fundamentals of this company is improving. If your definition is auto gross margin, you can say compared to last year, it's reduced, but every other definition of fundamental is amazing for this company. So that's why
volumes are lower.
So let me break the tie. I think, Gary, you're right and Herbert's right. Herbert is looking at it from an approach of a technology company. They're developing a robot long-term, FSD. This thing could be huge. It could be the biggest company in the world. I love that and I get it. And he's passionate. And I also get what Gary's saying. And I kind of fall more in that with the stock of owning it, because when you cut price and earnings go down and, the multiples actually expanded. When we hit 100, Tesla's going up not on earnings. It went up on multiple expansion. I think some of that was with the AI halo. AI was the big thing with NVIDIA, and the Magnificent Seven benefited from that. Tesla's multiples got stretched all the way back up to 80 on earnings going down. So I think the fundamentals, to be honest, they're not great from a business point of view from where they were. That's obvious, right? But I think what Herbert's saying is the business is progressing closer to a bot coming out, whether that's a year from now, 3 years from now, 5 years from now. It's getting closer to with V12, that FSD eventually is closer. So that fundamental's coming closer. So I think you are both have a story, and you're right, and they're both valid. And so I'm just articulating it. So I get you both. But in the short term, my position and Gary's position is right. I don't want to own this when it's really not accelerating its growth. But in the long term, you might be proven completely right, Herbert. When these things hit and it becomes the biggest company in the world, then you're going to be right long term. So I think it's just different ways of thinking about it, short, medium, and long term. Yeah, but great.
Oh, let me ask you guys this question. Just a couple of weeks ago, the sentiment for the market was absolutely down, right? You sold everything, Christian, and you sounded great because everything down. In a day, all of a sudden, the market flips back because now they know that the Fed is pausing. Now they're starting to sound a little bit dovish. Now they're talking about potential pivots. We know that these things are going to flip in a second because the Fed is just doing their rhetoric to try to control until what Jeff says, the day, the month that they're ready to flip, they'll flip. And when they flip, they're going to flip fast because they can't afford high interest rates for their own debt, the government's own debt. And next year's an election year, they're going to flip. They cannot continue this scenario. When that happens, the market booms, and then you're going to be caught sitting there. Let me tell you a quick story just to hit this home. When COVID hit, a friend of mine got a call from his brokerage firm, said, sell it all because the stock market just started crashing. Sell everything. He sold everything. In less than 3 weeks, it flipped right back, and it went not only to where it was when he sold it, it went higher. So this guy who was told by a stock broker, sell it all, and then we're going to buy it when it's low. Great, sounds smart. But what happened was he missed it. So he ended up losing more money than if he had just held on to his stock. If you can't predict these wild swings that can happen in just 1 week, which is what happened just now. Not that I'm not saying we're in a boom market or anything. It can flip right back right away. I'm just saying that I can't predict it, but it can happen quickly.
But absolutely, Herbert. But let me follow up since you brought me into it. So what I'm saying is I have other opportunities. So I'll just talk about it. So Lemonade's up 60, 70% in 2 days. That's a company that I follow. I used that money because I thought their earnings were going to come in better. And that thing exploded. So I'm making a lot of money in a short period of time where Tesla is doing all right, but it's just hanging out. So I understand what you're saying. I'm not advocating this to anyone, but what I'm doing is completely different from what you're doing. I'm trying to compound money, and what I'm doing is risky, but I'm comfortable with it. I've done it for many years, and as you do it, it becomes less risky. So I understand what you're saying, but if I miss a move, or I protect capital also. Like, I'm trying to compound, so I don't want to take huge losses, and I want to try to gain where I think I have an edge or an advantage. So that's different from what you guys do, and I get that. So it's not a right or wrong, but I just want to clarify. What I'm doing is, yes, sometimes I'm in for a few days and I'll sell a position. I don't have any tax consequences because I'm in retirement accounts. So it's different for me. And, I can get back in and go long term, and I can hold for months or years if I want to. So I just do different things. So I understand what you're saying. You can't predict, but you can also compound. And if you see in front of your screen that you're compounding money at 20, 30, 40% a year, I would take that than rather being flat for
yeah.
3.
Can I?
So
I'm taking too much time. I want other people to come in here, but I just want to report. I'm like a Ron Barron, where you're looking for the 10x, 20x, not for the 15 at 20% compounding each year. I'm looking for the 10, 20. And Tesla is going to go 10x, 20x, not because of the auto business. So even though the auto business is where it is now. Now, I do agree with you that the robot and the autonomy won't happen and may not happen for many years from now. So go ahead. We should probably do what you guys are saying. You're probably correct. But when it does happen, it's going to be a 10x. And that's why I think at the end of the day, my returns will be better. Now, again, my approach and your approach is not I'm right, you're wrong. There's nothing like that. I just want to, answer the questions of what Gary was saying is, how do you look at it when the margins fall? That's just the way I was saying. That's all.
Okay. And I would like to jump in here and actually ask a question to Gary that's different. So since you mentioned Ron Barron, we know he has the mutual fund that has, I think, 40% Tesla, 10% SpaceX, and then the rest. is quite known about it. It's a mutual fund. You only get a portfolio once a quarter. It's not at all tradable like the ETFs are. So there are advantages and disadvantages to mutual funds versus ETFs. Now, ARK 2 or 3 days ago announced that they bought 9% of SpaceX into their venture fund, which is a small 22 million mainly closed-end fund. They have a couple of exit strategies. You have to pre-announce when you want to sell, whatever. It's not a liquid fund. It's nothing compared to an ETF. But I wanted to ask, Gary, is SpaceX something that you could incorporate into an ETF? And if that is the case, is that something you're looking at? Or is it just, since it's not publicly traded, a no-go for any ETF?
Well, we could, but I just want to go back before I answer that, because we are not short-term investors. We don't say, like, as you were pointing out, Herbert, oh, COVID's coming, so let's dump everything. We're usually close to 100% cash. And we've had the same view about the Fed. We've been wrong. We thought that the Fed would start cutting rates later this year because as inflation came down, we thought they would cut rates. So it's taken a long, but our view on the Fed is not changing. We don't jerk our economic forecast around based on what the Fed's thinking. I mean, to me, what the Fed did the other day was very consistent with where they were last month. But a lot of people were, I guess, surprised by it. But it's the same view we've had about the Fed. They come next year, rates are going to come down because inflation is coming down, GDP growth is coming down. You're going to see the unemployment rate start spiking up, and that's going to be good for growth stocks. And that's why we stay with our growth portfolio, and we don't jerk around. Now, on SpaceX, I struggle with it because even if we were invited to go in, it's an illiquid investment. And to your point, Alexandra, it's hard when you're running an ETF and you have people either redeeming every day or coming in every day. It's hard to do that in a very liquid type product. I'm not the biggest fan of I'd say space travel. I like the idea of if you're going to put satellites up there, you're going to use them as communication tools. I think that's a good thing. But to charge people $200,000 whatever to go as what's the other space company does, it stocks at $2, right? Because there's a limited TAM for that. I have no interest in something like that. But if you're going to send Starlink up and it's going to be used as a communication tool so that you can get the internet all over the world, I think that's great. And if that was a publicly traded company, we would probably buy it.
You mean the Starlink side of it or the whole SpaceX
No,
part?
the Starlink side of it. I think the Starlink, but again, it depends on the valuation. If you're going to price it at 100 times cash flow, I probably wouldn't be interested in it. So a lot of it depends on the valuation, but as it's priced right now, I probably wouldn't be interested in it.
Are you talking about Virgin Galactic?
Virgin Galactic, thank you. Yeah, I mean, it's been a great short. We haven't been short it, but it's gone from like $20 and now it's like $2, because charging people to $200,000 to go fly up for 8 minutes and look at the Earth and come back. There are very limited people who can do that. I mean, once you get them,
yeah,
they're not going to go up again.
Gary,
it's not a great business model. It's not a great business.
Yeah.
model.
You mentioned so like the Fed macro. If there's anything I learned from the last 3 years, is like sticking your head in the sand and not looking at data is it's dangerous. And and so you can't, like the saying is, you can't time the market. I think it's you can't time the market perfectly. So with the Fed, I agree with you. I mean, we was like 99% that they weren't, or 97% that they weren't going to raise. So with the yields coming down, and it seemed like the tone has changed from, we're higher for longer. The threat, like you're saying, with the margins compressing on Tesla, you're kind of picking the bottom here and thinking that Q4 will be either flat or go up a little bit. So is the Fed kind of signaling? What is your interpretation on that they're not going to raise anymore, even though we didn't get a dot plot? What's your analysis on the macro of the Fed?
And since the Fed announcement and Jay's press conference on Wednesday, if you look at the two statements from September and October, they barely changed, and I don't think his comments changed that much. But what Powell didn't say, and I think this is why the market got excited, he chose not to be hawkish, even though, remember, the September jobs number was hot. It was like 336. The inflation number was hot, And so he chose not to be hawkish and instead said things like, the dot plot from September is stale, and we're going to look at each meeting. We're going to approach it and be data dependent, and we're going to be very careful, which is code word for, we're going to be reluctant to just change. So I think a lot of people, not us, because we felt that he wasn't going to raise rates either in November or December. And I think, but a lot of people were surprised by the tone shift. And so you can look at what the odds are. You can look at the implied odds of a rate increase. And, they've dropped from now, it was like 45% by January. So you take December and January, it's 45%. Now it's 25%. And that's what's causing the 10-year to drop. I think the 10-year is going to continue to drop. I think one of the best.
You're dropping. Sorry, Gary. Your camera's falling.
Gary, can
So
you fix your camera?
I'm sorry.
There you go.
I think one of the best bets you can make as an investor is to buy TLT, because I think the 10-year is going to go back to about 4%. But I've been wrong. I felt that was going to happen all year, and it hasn't. Even though inflation has come way down, the Fed has, in their language, they've been hawkish. And this was the first call, and some people say, well, he was a dove. I think, Jeff, you said that. I don't think he was a dove. It's just he wasn't a hawk for one. So on a relative scale, he was dovish. But I think as you get into next year, and as the unemployment rate starts picking up, right now it's 3.9 versus 3.4. That's a huge jump. If you look at other periods where the unemployment rates jump by half a point, it's usually portended recession. And so I think as we get into next year, and as the job growth continues to slide, and as consumers continue to save more and not spend more, I think the Fed's going to be very quick to, at some point, start cutting rates. And therefore, as long as you're not in recession, you want to be buying the Teslas and the Palantirs and the Celsius. So those things with very high P's, Rivians, anything with a high PE is going to work in that type of environment, as long as you're not in recession. But if you're in recession, none of those are going to work, right? Because people will just shut off and stop buying anything because they're afraid for their income, and they're afraid for their jobs.
I'm not sure about Celsius though. I could see people that purchase is not that much, then their demand and growth is so exceptional that I still would think that they would be okay even in a slowdown environment. But I agree with you on the macro. I thought Powell was dovish. I heard a couple statements. He almost said he would bail out the stock market. I think I heard that right.
That's new. That's a new thing.
Yeah. And I've been calling the Fed pretty much right all year. Not to pat myself on the back, but I don't think they're going to raise again. I think the next move is a cut. And it's just how long do they stay up here? And I think that the Fed is cognizant that interest rates with the debt and the deficits we're running and how much is going to come out of the budget on interest alone. I think they're cognizant of that. I think inflation's coming down good enough that I think we are done. And it's just a question of, do they want to cut or how long do they want to hold out? And it's almost a game of, will recession hit, or can the soft landing take place and they can slowly bring rates as inflation comes down as we get better data? So,
Gary, can you be a little bit more specific about the interest rates and Tesla? So if the Fed pauses and it stays this way for next year, some people are saying that the actual cuts won't actually happen until 2 years from now. Do you need to see cuts before Tesla itself, the stock, will rise? Because you said there's two things, right? It's not only the fact that it's we're not in a recession, we're in kind of like a better mood, but also the interest rates impact people buying high value cars.
Yeah. Well, there's three catalysts for Tesla. One is people for me, and I think people who think like me. One, you have to see that gross margins have bottomed, and gross margins, again, third quarter was 16.3. The street right now is looking for gross margins to rise in the fourth quarter. It's actually even above 17. I looked this morning, it's like 17.2 or so. So that's the first thing people look for. The second thing is the narrative that EV adoption has stalled has to be refuted. And I think you have to see data that says in the fourth quarter, EV adoption keeps moving up, because Tesla gets its fair share of that. 50% in the US, 20% globally. And the third thing, which you're highlighting, is that people have to continue to believe that rates are going to fall. So today, and you got to look at the 10-year, because the 10-year is what people use when you're valuing a cash flow stream or an earnings stream. So, the way we think about it, there's a cost of equity and you discount back earnings, and you can do it that way, or you can use a cost of capital and discount back the cash flows and then back out the debt. We just choose the first one because it's easier to understand. And so you start with a 4.5% 10-year, where a week ago you're using a 5% 10-year, and you build it up by adding an equity premium. And again, if you're discounting that back, you're going to value Tesla's earnings, no matter what they are, at a lower rate. So therefore, Tesla is worth more. So if Christian says, hey, the 10-year is going to 4% by the end of the year, you would want to be buying anything that's got a high PE where the cash flows are in the tail, because that tail is now going to be worth a lot more. You wouldn't be buying a GM or a Ford because all the cash flows are up front and the cash flows actually start declining. And so those are the three things that are going to make Tesla go up. And to answer your question, I don't think you need to see the Fed cut. I think you just have to get the market to believe it's going to cut. And I personally think that as the job growth slows more, we saw a pretty weak number today, and then you get these every month, the first Friday of the month. I think as things get down close to zero, that's where you get into this debate of can the Fed navigate this Goldilocks soft landing where you can cut job growth down to zero, but you don't go negative. Because if you go negative, then people aren't going to buy Tesla, and they're not going to buy any consumer durable company, because then they're worried about their jobs, they're worried about income. Then you're in a recession environment like 2008, 2009, and that's not good for a Tesla stock. This is not, because recessions are bad for car companies.
Yeah.
So to answer your question?
Yes, absolutely.
So with like a couple of weeks ago, we were looking for the FOMO in the market, and especially with Tesla, right? With the earnings call, you had a sentiment shift just within the bulls as well. That where's the earnings going to come from? Those are the discussions that we had, and I think we kind of all came to the same conclusion. And guys, jump in if I'm wrong. That we need the market overall broadly to shift, and to have this Fed kind of signal that we're going to pause, no more threat of a rate hike, and now we can because the FOMO for Tesla stock can, like Herbert was saying, can return very, very quickly. Alexandra asked you if you're going to grow the position, so you don't have a FOMO of Tesla kind of running away with the margins, but is it possible that, like, is it just you're not in the position to kind of gamble this way like we are, to just bet on one of these optionality things connecting and hitting and the FOMO returning into the stock?
I guess I look at it as, remember, price is equal to earnings per share times PE, and you can use 2024 earnings, you could use 2030 earnings if you want to capture some of these options that you talk about. And we choose to use 2024 through, and we look at 2030 obviously because that's what our price target is based on. So back to your question and to Herbert's question as well, you got to think about what's going to drive earnings, and that's going to be volumes and pricing and cost, but volume and pricing are what drives earnings more than anything, and margins. And then the PE is a function of expected growth rate going forward, which is driven by EV adoption, and it's driven by interest rates. Again, that's that whole discounting process. So if I was convinced, for instance, that Elon had learned something from this year, that by cutting price he's gotten no volume, if I was convinced that he had wisened up, then I would take the position back to 10%, because I actually think gross margins are the most important thing that investors are looking at. And if he doesn't even cut pricing, or just leaves prices where they are, margins are going to drift up over time, just because the volumes are going up. You get more economies of scale. The new Model 3 is being priced higher than the old Model 3. And Cybertruck margins, forget what Elon said on the call about, it's going to take a while. It's priced higher than his average selling price today. And so you're going to get higher margins over time, even if he just leaves prices where they are. This second issue about EV adoption, I just think it's bullshit. I mean, I look at the data. I get data all the time, and you can use Cox data, you can use Ward's data, which is free, or you can pay for it like we do through EV volumes. You can see that EV adoption is not falling, and it's growing slower than it was, but it's still growing. And so that gives you this built-in growth rate. This goes to the PE question. If you believe that, as I do, that EV adoption, which is 12 globally, is going to go to 60 by 2030, That's a 30% compounded growth rate. That's a huge tailwind for Tesla just by being in the leader in the market. You're going to get, put another way, if they just hold their freaking EV share, which I know people hate that term, but just bear with me for a minute, their volumes are going to grow at 30%. Their earnings can grow at 50% just because of the way, fixed costs kind of stay the way they are. You don't really grow fixed costs at 30%. You're leveraging your fixed cost base. And therefore, you want to be in stocks like Tesla because the earnings per share grow by 50% per year. And I can't find in the Magnificent Seven anything except maybe NVIDIA that's going to grow earnings at 50% a year. But I have to be convinced that Elon's not going to destroy us by cutting price more. And that's a short-term concern, but it is something as a stock picker you have to consider, right, when you're picking stocks. And that's why I go back to what I asked Herbert. If you knew with 100% certainty that he was going to cut price and therefore margins were going to go down and therefore earnings go down, would you cut your position and buy it back? I would say you should, but Herbert's saying, no, I can't do that. And that's fair.
FSD might come sooner than you think. But I may. I'm saying I may actually do that. I'm just saying I'm not going to cut all of my position. Right? I'm perfectly open with people playing 10% or something of their their worth to play with that. So just be clear. I'm not like 100%. I'm going to just hold forever, and I refuse.
That's what we did, Herbert. That's what we did to it.
I know.
We cut our position back. And we're sitting here, we're watching it, and if I was 100% convinced he wasn't going to cut price more, I would add it back now. But we cut our position back at 265, and we're still we're at 220. So we have a ways to go. And if I knew that he wasn't going to cut price more, I would buy it back today.
Okay,
I have a
Christian,
question
if you want to answer it, go ahead. But I do have a question I want to ask shortly.
So
I
was
just
going to ask Gary
if you can
a quick
keep
question.
it short.
Yeah, I'll keep it. Gary, so you actually been more bullish than me on Tesla in the short to medium term. I'm looking at it and I'm saying, okay, we have no Giga Mexico. We have them cutting prices. We see the operating margins going down. I think you've actually had a lot of patience with Tesla. And, I'm actually surprised because I see so many other opportunities. And I understand what you're saying long term. You see the EV share and Tesla, and I get it. And I'm bullish in that too. But I just want to get your thoughts on that as a fund manager, because I'm looking at it saying, there's a lot of companies out there that are killing. Their revenues are exploding, and you own a lot of those companies, and their earnings are growing in this environment. And we have a call with Elon. Again, I'm just stating facts, and we're just having a nice discussion. I love Tesla, and I think long term it's a great company, and the stock will do well. But we're talking about the short term right now. That conference call was depressing. So as a fund manager, you hear Elon talking about all the challenges of the business. You talk about Elon not very bullish about the business, talking about macro, talking about interest rates. So do you ever step back and say, hey, should this be my number 2 position? I got all these other companies that their conference calls are upbeat, they're handling the macro better, and maybe I should own a little bit more of them in this environment when Tesla is having a little bit of a struggle because of the macro. I would love to get your thoughts on that.
Yeah, well, we're at 6.5% today, which is probably the lowest we've ever been. And look, my partner and I debate this every single day, and he's a tech guy, so he loves some of these tech names that he knows more about than I do, and we're constantly sizing upside versus downside. So I'm comfortable with 6.5. Where I've been wrong about Tesla all year was I did not think that they were going to cut prices aggressively as they did. I just didn't think that they were that. I don't want to use the word dumb, but I didn't think they were that irrational. It just doesn't make sense to me, because where I was right, they didn't get the volume growth that they thought they would. I mean, because Elon would get on the calls and say, yeah, we've got 100% increase in orders, and everybody knows that he just pulled forward volume that he would have gotten anyway. Everybody knows that in the industry. But he would say stuff like that, and everybody'd say, oh, well, it must be working. And then we'd get the volume numbers, and we'd see a 435 number instead of a 455 number for third quarter. I shudder for fourth quarter if they miss again, where if the volumes, I think the street right now is at 480 for fourth quarter, down from 500. If they come in at 460. So where I've been wrong, and if I knew this going in, I wouldn't have held as much Tesla, obviously. Where I've been wrong is they've cut prices much more aggressively than I would have liked. It seems like, remember, they took Model Y long range, which is the best selling product in the world. They took that up by $500. Even though that's a small number, it's very symbolic. It's in one way telling me that the next price moves are up, not down. I'm holding on to the concept that the Model 3 refresh is going to be priced higher once it hits the US than where Model 3 is today. And I'm also happy that the Cybertruck's going to be priced, probably starting at 79 instead of 59. So that's going to give me some positive margin versus my expectations. So to your point, that's why I still hold Tesla. And to Herbert's point, look, I'm a believer that FSD, as it gets better and better, we'll sell more Teslas. And I'm not a believer so much that they can, get more take rate on FSD, at $199 a month. But I think the news, because I'm an ex-brand guy, I used to work at Tylenol. When you have news in a category, whether it be Cybertruck or that FSD is now driving itself, that's going to sell more Teslas. And so that's why I hold a 6.5% position rather than cut it even lower.
Okay, let's get to a new topic here. I want to get Jeff back in the conversation and you, Gary. So this was a question that came from an audience member, which was, with a lot of the announcements that's been recently made by many of the legacy automakers that they're going to slow down their EV forecasts and their investments in that. What does that do for the supply chain for Tesla? What are the different benefits that might actually then benefit Tesla in the next several years? So Jeff, can you answer that?
Yeah, I mean, if you're a supplier to Tesla, you've got some assurance that, when you look at their installed capacity and you look at a forecast from them, they're going to take the parts. And if you look at what happened and what's happening right now on the Ford and GM side, nobody tells this story, but Ford and GM gave their suppliers forecasts. Those suppliers hired people and they installed capital to some level. And now they're capitulating on that. They're not taking that. They're not going to take the parts. They're not going to say, "Yep, we'll take all. Don't worry about it. We'll be your." No, these suppliers are getting screwed. So there's a psychological impact, and there's an actual physics impact of not investing in capital, and the cost of capital is much higher to invest next year than it would have been 2 years ago when they should have been investing. So there's significant supply chain implications. What you see Tesla doing is you see them installing the 2.3 to 2.5, depending on how you look at it, capacity, and they're basically telling their suppliers what they need to grow to. They're also adding suppliers. They don't just keep the same stagnant supply base. The legacy auto supply base, from the experts I've talked to and from my studying of the volumes over the prior years, it looks like they're over capacity about 30 to 40%. So when you take a supply base and legacy that's been over capacitized 30 or 40%, so they're sitting there with excess capacity, their fixed costs are going to be higher. Their ability to give cost downs or cost reductions to a GM or Ford are going to be, deprecated at that point. And now you tell them that, hey, I've been giving you this bridge to EV business. We're going to grow with you with EV. And now I'm pulling all that back. And especially the EV only suppliers that they're working with as well. They've basically flattened them. There's huge implications on the supply chain. And let me tell you one more thing about, this competitive dynamic between a Tesla and the others. The Tesla supply chain is designed fundamentally different. Both the engineering workforce in Tesla and the supply chains are designed fundamentally different. You can't just go look over at Tesla's paper, as you say, they're all taking a test, Ford, GM, and Tesla. You can't just go look at what Tesla is doing, copying it, and have it ready next year. It doesn't work that way. This is years of development and many, many different stages and layers of the supply chain that need to be developed. Has Ford kicked something off? Have GM kicked something off? Are they, everybody can build a battery plant, right? Well, guess what? When did Tesla start building that battery plant? With Panasonic back in 2015. So they're doing their first joint ventures now, and it's not even clear. They've stalled. They've actually stalled several of the battery plants, and Alexander just shared that VW has stalled 3 of the 6 operations that they were going to stand up. So this delay that is coming from VW, GM, Ford, and some of the other rhetoric we're hearing is going to have significant implications. This is the psychology of supply chains. Their suppliers are going to start, even if they get a demand signal from Ford and GM says, I want this many in this quarter, their suppliers are sitting back and they're second guessing saying, I think they're going to do more of this. I don't want that. I don't want to take a chance on EV. They cut their numbers 4 quarters in a row. That's how suppliers think. So now they're going to have more and more supply issues and shortages. When they decide to restart their capital plan, they're going to have a lot of shortages and a lot of trouble getting supply. And again, they're fundamentally different supply chains. I want to make sure that that's very clear. The legacy supply chains, even their approach to EV, highly layered, very long network latency, and what that has huge implications for inventory, that has huge implications for the ability to respond to changes in demand, and it has huge cost implication in terms of the number of people touching parts. So very, very dramatic difference, and it's going to take a number of years. I don't even think in the 2025 product cycle they're going to even be close to the products that Tesla is putting out in 2025. They're going to need another full product cycle, I believe, to get to where Tesla is today. Now, again, that's the kind of the US and some of the European piece of it. In China, it's a little bit of a different story, but we're not clear on the margin picture right now in China. And I think that you're going to see a lot of EV players in China just literally implode. And the question will be is who's left, and have they fundamentally, basically, have they fundamentally forged a path to profitability yet or not?
Yep.
Okay.
Oh, I love this view. I get to see everybody. Herbert, you should have done this more.
You got to see Gary Young.
Okay, let's move on to another really big topic. So first of all, just a quick shout out to everybody on this panel. You folks, you guys, you experienced it so far in the first hour here. This is experts in the field. We bring them into this conversation. So very appreciate you, Gary, and everyone else. So follow these folks on X, follow them on YouTube. And then, of course, Gary is found at thefuturefund.com. Check out his website as well. So this next topic is a big one. We were just talking about the announcements about many of these American and European automakers slowing down their EVs. But what is not slowing down is the Chinese automakers. So now we've got Alexander Mersch. He's going to do a deep dive on the Chinese export boom that's coming together. So Alexander, take it over.
Well, thank you. So let me first state something. Not all Chinese car makers are going to make it, right? This is a competitive market, and building car companies is a tough job. And even if the Chinese government is behind it, there's going to be a selection process. We had this morning the news that NIO is laying off 10% of their staff. That may really be a precursor for quite a few more trouble to come. But there are some strong ones in there, and I think we should keep an eye on them. And they're actually making enormous progress. So I didn't do a huge deep dive. What I did is analyze a Substack article that Glenn Mercer wrote. Glenn Mercer is, for me, one of the best ones, having a good oversight view on the worldwide car market. And so I posted that one, and I just want to show a couple of the graphs he used, which are not graphs he produced, but that he assembled. So the first one was actually in the Financial Times, and it shows what happened in the last 4 years, right? Up to 2021, China was non-existent in terms of exports of Chinese cars from Chinese car manufacturers, obviously not including Tesla, to other markets. And now for the first time, it has surpassed all of them, meaning the South Koreans, the Germans, and the Japanese. The Japanese, the Glenn thinks is they're gonna, it is first time it did, but it will stay sustainably above Japan. So this is a big one. Now, of course, it's not the same model mix, it's not the same, but in terms of quantity, it is considerable. So when I hear people say all the time, "Oh, we don't see Chinese cars yet," that is true. Let me get into where they are and why they're not everywhere. So the first thing to retain is they are moving fast. And then if you could go to the second chart, Herbert, if you don't mind. The next one, exactly. So this is how they're actually attacking Europe. So you will say, why do they not attack the United States? Yes, that is because we still have the 27.5% tariffs bringing these Chinese cars into the United States. So it is not profitable for them. And also they don't have at all access to any of the incentive, the 3,715 or the 7,500. So they're mainly attacking Europe at the moment. I'll come in the next chart to how they actually do that. And then the question is, how do that? Now, if you don't, just keep a second on that one. So how do they do that? So MG is an old English brand that has been bought by the Chinese. That brand was the first one to come back to Europe. And they have approach of free dealers, because the big subject for these Chinese car makers is how do they distribute, right? That they can produce actually quite safe cars. We've seen loads of 5-star safety ratings for these cars in the last couple of months. The big question is, how can they distribute, and do they actually lose an important part of their price advantage through the distribution? And obviously the next lagging subject is, what is the European Parliament going to do about these Chinese imports? So that's still pending, and that should be part of the discussion once we have more insight. So MG is going through a free dealers approach, meaning any dealer that wants to take the MG brand can take them on. Then you have Polestar that has the old Volvo dealers. Obviously that's historic. And then you have a couple that have the same distribution model than Tesla, meaning you go on site and then they have their stores. That's NIO. And then we have a couple that are trying to use what is called the Emil Frey group, which is a conglomerate of different dealers. So all this is actually very interesting, because that determines whether they can sell with a profit or not. So this is all still moving, and is really complicated for them to find the right dealer networks. But once they have them, and once they can have a sustainable margin, even though they have to pay these distribution partners, they may actually be in for much more. And if you don't mind moving to the next one now, Herbert, which is a study from IHS. IHS is now part of Standard & Poor's Global, on how they approach the worldwide market. So you see in the left column in 2022 that the main country they exported to was Egypt. Isn't that funny? Then Israel, well, not this half of the year, then Norway, Thailand, New Zealand. So rather minor markets, Australia coming after next, and Germany was only 7th. They estimate that by 2025, the main market they export to is going to be Germany. I just showed how they plan to distribute there. Then Thailand, then the UK, then France, then Australia. And by 2030, it is still Germany. The UK will have moved up, the Thailand one down, Australia one up, France one's down. But as you can see, there is still no United States there. So they do believe, S&P IHS believes that, and this has also been done actually by your friend Tony Sagonagi's group, they do believe that they're not going to get into the United States. Now, the fourth chart is, in my view, the most interesting, but also the most complex. So just bear with me. I'll try to put this one into words. So this is the sales volume curves from different car suppliers, how they approach worldwide markets. So there is Toyota on here, Hyundai on here, so Japan with Korea, then Tesla, and now BYD. So we have 4 curves. And I know if this is little to see on your screens, I'm going to post this again as a tweet a little bit later. But what it shows is that it usually takes a car maker between 4 and 8 years to get to about 300,000 cars exported, and about 5 to 15 years to get above this 300,000 line. The 300,000 seems to be really the break line, right? And then in the good old times, it took these car makers between 10 and 12 years to really get at least to 150,000. So you had Toyota that was a bit better on it, but it really took them to 12 years. That's exactly that point. Hyundai had it for a long, long time. It took them 18 years. Tesla was good, but it took them 10 years to get up. And these Chinese are at T+3 years, right? This is the crazy thing. And the question now is, will it happen what is here in this turquoise lower line, that they stay in that 300,000 bracket for quite a while, around 150,000, or will they be able to exit and get into the above 300,000 very quickly, which will be never seen before? So it comes rolling into these markets at a high speed. It's not because we don't see them in the United States that it's not happening. They are much safer. They are actually, I still read people telling me, yes, but their build quality is not the same. Well, I would not bet against the Chinese in terms of build quality. I think they are good at manufacturing, and if that is the topic, how they can make it work. One thing I am, however, concerned about is their profitability, right? At the moment, it is just not profitable yet. They're throwing a lot of money out there. I think there won't be more than 2, 3, 4, 5 that will survive. BYD will be one of them, but it is a really tough market. And then there's a last chart, if you don't mind, and now I'll wrap it up, which is which is this one. This is European registrations. This is the only chart that actually breaks it down into electric vehicles up to now, because obviously these Chinese car makers make as well quite a lot of ICE and hybrids yet. So in terms of the United States sales, the bottom part of it, obviously no Chinese brands to be seen, neither in the total market nor in the electric market. But in the European registrations, already in the first half of 2022, last year, they had 17%, and now they have 45% of the battery electric vehicle registrations in the first half of 2023. This dark green here. And so this chart has lots of other numbers. I don't want to get into all of them, but what is really surprising, because lots of people don't believe that the Chinese can be taken seriously on electric vehicles in Europe, and I just want to call them out. Be careful, keep an eye on them.
But Alexandra, you yourself said just recently that 3 Chinese automakers are in Mexico right now, and the potential for them to use the trade agreement to go into the US.
Yeah, they would have to construct completely in Mexico. So they would really have to have the whole factory set up and all that. And that the US, Mexico, Canada trade agreement stays the same. So that's a lot of prerequisites that who knows what will happen, right? But that's their bet. That's one of the things they're trying to enter the US market by factories built in Mexico, because they do understand that is probably the only way to get their cars here.
Great presentation. Thank you. Anybody else have a question? Yep.
I have a question, Alexandra. So the Chinese never used to export. Tesla kind of gave the Chinese, right? The Chinese Teslas going to Europe that in, and now is that what spurred all these other Chinese manufacturers to go to Europe, because they've seen the quality of the Teslas and it just kind of the government got what they wanted? Is that kind of what happened?
Well, traditionally, China has always been an export nation. Remember, this goes back to the Silk Roads and everything. I mean, China has cheap and relatively reliable labor. Not saying everything is fine in China. I'm quite critical of China, but the West has used China as their factory now for decades. So the cars were just the last bastion that was not conquered yet, right? They didn't have a car industry, and it is just absolutely remarkable how quickly they built one up and how quickly those brands were ready to go up. Again, distribution, repair, maintenance in Europe and later on in other parts of the world are still to be organized, and that is currently eating all their margins, but that can all be sorted out. This is, yes, they do have still a big to-do list, but this is the competition. Their affordability, once that is sorted out, their affordability is putting pressure on everybody else.
Thanks.
All right. So we've covered quite a bit on the Tesla stock. Thank you so much, Alexandra. Your deep dives are so amazing. We're really, really fortunate that you do that and take the time. This stock market, I know that Gary and the others here are very interested in not just Tesla, and we like to sometimes cover what's going on. It's important, first of all, to cover the Mag 7, Magnificent 7, and Apple, Celsius, and maybe, if we have time, Lemonade. So why don't we start with the Apple and Magnificent 7? Gary, give us your kind of, I know you watched their earnings call last night.
Yeah, hold on. Okay. Apple's beloved. Everybody loves to own Apple because it's steady. You have this big service component that's growing. everybody needs to replace their iPhones every 3 or 4 years. So it's a beloved stock. They basically have had 4 quarters in a row now where revenues have declined. Last night was -1. It's the Christmas quarter. And so, the stock was down this morning about 3%, which is probably about right. But it's a very expensive stock when you.
Okay, we just lost them. So while he comes back to talk about Apple, 3 of us here made tremendous amount of money, and not me, on Celsius. So why don't we go talk about that? There's Jeff, there is Christian, and then recently, beautiful Xander's playing Celsius now.
Whoa,
Tell
don't
us
put me
Why
on
do
what
you
this
blast
call him
company's doing.
beautiful? What's this now?
I am beautiful.
The only beautiful here is Jeff.
I was referring to the trade, not to him, but okay. So Celsius is a beverage, guys, but its marketing is being taken off. So you guys are watching this momentum. Who wants to start on Celsius? Who's the bigger Celsius fan? Is it you, Jeff, or is it Christian?
I mean, I've been in the name for a couple of years trading it, and actually since 2020. So this company makes a kind of a natural energy drink. It's beloved by many, and they've been mired in kind of distribution issues for a number of years. And last year, Pepsi made a very big investment in the company, $500 million.
Mhm.
And that's really helping them from a cost structure perspective and the production of the product, as well as the key thing is giving them Pepsi distribution, which has basically been expanding over time. So it's a highly volatile name. It had a high forward PE. It's been coming down a bit, but I was in this in the 40s, and just this has been an interesting stock to be able to swing trade, where you don't have to be married to it. You could have just bought in the 40s and just sat there, but it's had these huge swings, for a number of different reasons. But really, their business performance has really stabilized. They've been increasing prices, and they've been increasing volumes. Their volumes are up anywhere from 120% to 140% in some channels. And then when you layer on the pricing increase, they could have revenue growth over 160%, and they've been doing this quarter after quarter. So, and yesterday they announced that they're going to do a 3-for-1 split on the stock, which is, they believe that, it's bullish. They want more retail entry. They believe their stock is going to grow over the next couple of years. So it's been a great one, and they have earnings next week. So we'll see.
Yeah, I'll jump in. I love it. And Herbert, I know you said it's just a drink company, but I'll give you some history. And Jeff, I do my own research, and when Jeff introduced me to this, I deep dived into Celsius. I listened to all their conference calls. I listened to all their investor talks and things of that nature. So I do a deep dive before I do anything. But when you get an idea and it looks good and the growth is amazing, and this is not financial advice, but if you look back, some of the simple investments are the best. I mean, yeah, it's a drink company, but the growth is phenomenal. And what you're trying to do in investing is you're trying to compound capital. That's what I'm trying to do. I'm trying to get the best return on my dollar that I can do. So when you see a company that's putting up the numbers they're putting up, and you can get in an attractive price, you should do it. I mean, there's a company called Monster Beverage. They, I think, and I may be wrong, they are one of the greatest returns. I think they're in the S&P 500 ever. It might be the greatest over a period of time. So again, you can make fun of it, but it's given you great returns, and it's a simple business to understand. So if you can just do some basic research, get comfortable with the story, and again, there's no sure things in life, but if you can get comfortable with it, it's been a great investment. Like Jeff said, Monster, who had a good earnings, is up. They have a 60 billion market cap. Celsius right now, I believe, has about a 12 billion market cap. It fluctuates it's been anywhere from 10 to 13 billion in market cap. If they can become, and they're growing market share, and they're growing, like Jeff just said very eloquently, over 120%, 130% as they're increasing prices, and their international growth hasn't really happened yet. That's to come. Who's to say that in 3 to 5 years that Celsius can't be the next Monster and be a $50, $60 billion market cap, which would be a 5x on your money? So I think it's a good idea. Again, this is not financial advice, but I think Jeff laid it out well, and that's kind of what I'm doing. So I'm in the name, and I'm being patient with it. I've done well with it, and we'll continue to watch the story. They do have earnings. They just did announce a 3-for-1 split, so there is momentum in the name. You know, I like that kind of stuff. So you know, it's a good story. So I like to hear what Xander has to say, but
Yeah,
I think it's a great company, and the growth is amazing.
Let's get Xander. We're talking Celsius, Gary. Let's get Xander to reply, then we'll get back to you. So Xander, stock split for Celsius. You decided to play just now, and tell us why.
Yeah, yesterday. So I my first options trade was AMC, and there was like the brief history is I wanted to do an options play. I wasn't ready to do the S&P 500 when Emmett Peppers did his trade, but I was studying. So there was some data that came out, which was the CEO announced that they were they secured like I want to say $1 billion, was like 930 or something, and so I just YOLO'd my stimulus check into options and got a 10x in 2 days. So that's the thinking that's going into this. For me, this is completely just a trade. I'm not like long term, so not financial advice. Don't follow. But the fact that they, a week before earnings, announced a 3-for-1 split, the earnings, like the growth, has been just tremendous, and so they're just showing their bullishness. And then I kind of looked at some of the details of, apparently it's like 50% women purchased. It doesn't use artificial stuff. So like, and then the Pepsi thing made me see that they have distribution. And if that's the new hot thing, and and the adoption is going to be there, that's where I see the opportunity to. I just bought stock after hours yesterday, and that's been up nicely overnight. But and I was up, and it's really hard. I think like everything that we're discussing has a lot to do with psychology. And I see I'm up $1,000 overnight, and I go, ooh, sell it. But you kind of have to see, this is a trade, and I have to wait for earnings to come, or at least see if that kind of Wall Street bets mentality plays into, and the story gets out, and other people have that FOMO to get in. So it's not a fundamental trade quite yet, but I do see why Christian and Jeff have been talking about it.
Just check it out, Alexandra. Look at her.
Busted.
So
Busted.
Don't do
I want to hear what Gary
that.
has to say, but I have to push it.
Come on,
push
I
it
got
on
a day
Xander.
job.
I want to hear what Gary has to say, but let me go real quick. So I love what Xander said, but this is not, for me, this is a fundamental play. This is a growth story, and this is a monster. Not to make a pun, like a monster beverage. Like, it is 12 billion market cap, and it has barely touched an growth. So again, this is, you could call it a drink company, but Monster Beverage has probably been the best return in the S&P 500, I think, in history. I could be wrong, but I think I remember reading that. So some of the most simple investments, some of the most easy to understand, are the best investments. Rather than worrying about, do they got to do this and they got to get this right, and the AI's got to work. Like, you could just make some simple research and get in at the right price. So you don't want to buy this thing at the high, because you can get cut down 30-40% in a quick and feel like an idiot. But if you dollar cost average, or if you know what you're doing and you can get in a good price, and you've done your research and you know the growth is coming, because this company, you can actually do the research. The Nielsen's come out. You can see what they're doing, and that's your edge, because a lot of investors, especially retail, might not even know that's going on. So you can get an idea what the earnings are going to be. Not exactly, but you can know if it's going to probably be good or not, and you can make a probability bet on that. Again, this is not financial advice. I love to hear what Gary has to say.
First of all,
and go ahead, real quick. My pushback is that I'm an all-in Tesla investor. Everything that we've been talking about,
Was
to
an
me,
all-in Tesla investor.
don't. I'm still getting comfortable with it. So it's this market timing, thing that I've evolved. That I see that the short term has pressure for Tesla. I want to, like you said, grow a little capital, but then I got to get back to Tesla because the fundamentals of Tesla are, to me, I can catch a 10 or 20x there. I don't see that happening with the 3 to 5 years that you're talking about. Where's Tesla going to be in 3 to 5 years compared to Celsius, right? And so you're diversifying and you don't know, so you want to do that. But for me, I really don't know, so I just I'll play around with a little bit of the portfolio, but it's all the idea is to shift it back.
Okay, so Xander, thank you for moving from the sauna to the washroom. Appreciate that. Gary,
I'm traveling.
Gary, you have an ETF, and I understand you also own Celsius. So please complete your thinking about the Mag 7, Apple, and then Celsius, please.
Yeah, well, in Celsius, we've owned it since about $40. It's one of our favorite positions. It's top 5. It's been top 5. It's about 4% position. We got into it because I tried it one day and at a friend of mine's, and it was a great product, had no calories, and there was like 10 different flavors. And at the time, they were using Anheuser-Busch to do distribution, and there was talk that they were going to switch to Pepsi, and Pepsi just has more distribution, particularly in convenience stores. So we got into it, and as Jeff said, what's nice about the stock is you can look at the Nielsen data, which comes out every 2 weeks. And so the way we do it is we look at how is it doing in retail. That's about 70% of their revenue mix. And so just as an example, this quarter, the September quarter, that revenue, because Pepsi took it over, was up 140%. So I could take 140 times 70%, and I take that number. And then the rest of the 30% it's Amazon. They sell it direct on Amazon. They sell it in club stores like Costco, and it's international. So you have to model how much is going to be in each of those. But let's just assume it's been about 50, 60% on that other 30. So you multiply that out, 140 times 70, and let's use 60 on the other 30. You get a number that's about 110, 120% growth for the quarter. And then what I do is I look at, okay, what is the street thinking? The street is thinking revenue growth for this quarter is going to be 87. And it's been coming down because it's just like EV adoption. Once you get to a high number, you don't get the same growth. So as you get into next year, the growth rate slows to about 40%. It's still a big number though. So, but for the current quarter, they're going to do probably 110, maybe 120% growth. The street's at 87, and this is still a revenue story. So as long as you can get comfortable, they're going to beat expectations, and they never guide to the next quarter out, so you don't have that risk. You can make money on this stock because it'll move 15 or 20%, if it beats. So add to that, I got a 3-for-1 stock split coming up, which, as Andrew said, you don't usually see companies announce that before earnings. The fact that they announce before earnings means they must be very bullish that the quarter's going to be good, because if they were bearish, they wouldn't announce a 3-for-1 stock split. So to me, that's a positive. And I told a client today, just buy it, even though it's up, I don't know, it was up $8 or something this morning, and now it's up more, because the fact that they're doing they announced the 3-for-1 split before earnings means they're bullish for the quarter, because they would have waited till after the quarter to see what would happen if the numbers are going to be negative. So we still like the stock. I think, the growth rate's going to slow, and that's, a lot of growth managers don't like deceleration. But as long as you keep beating estimates, I think you're fine. The street's pretty low for next year, and they're still exploiting this Pepsi distribution. And it's become kind of a cult product because, it's very high energy. You drink 3 of these. In fact, they even warn you don't drink more than 2 a day. But if you drink 3 of these, you get lots of caffeine, lots of energy, and there's no calories in it. And it's a great tasting product. So
Yeah.
it's a wonderful stock to own, and it's a wonderful product too.
Okay, let's
drink 3.
move on. Okay, well,
I love
drink
that.
three.
But I also just want to add real quick. You're talking about estimates for next year, but that's also the opportunity, because maybe they grow better than 40% next year. I think that what if they grow 50, 60, or 70, which I think is in the realm? That's your opportunity also, even though, because Wall Street, I think they're too low for next year, but that's an opportunity.
I agree with that. And again, I mentioned 70% of their volume is, convenience stores, food stores, drug stores. The other 30%, they're actually ramping up their growth. If you go on Amazon, it is the #1 energy drink now. You know, people buy it on Amazon. People buy it in the gyms. They buy it in the club stores. And international is still tiny. It's like 10%.
Yep.
And that's where their growth's going to come from. So, look, we agree with you. And it's one of these stocks that is very underfollowed, but it's very easy, as you point out, to just get the Nielsen data, multiply it out, and say, are they going to beat the quarter or not? And they will beat this quarter. And that's why the stock, you know, it could go up. It could go up another 20% from here as you get to split. And you know, there's all kinds of talks about splits. You know, do they add value? Not really. But when the stock is suddenly priced at 60 instead of 180, people buy it. We saw that with Tesla. And I used to have disagreements with my partner about this. He says, well, it has no value. He's right in theory, but because it opens up the TAM, if you will, for many more people to buy a $60 stock than a $180 stock. That day, which is November 13th, it's a Monday, when it goes when it goes X split, people will buy the stock the following day. So I think even as a trade, you play it through earnings and you play it to the following Monday when it goes X split. And then if you want to get out, you can get out. Back on MAGA, the only thing I would say is, you know, I like to look at the top 7, the Magnificent 7, just because, you know, it's the universe that Tesla plays. And Tesla's now number 7 because it's dropped below NVIDIA. On a PE to growth basis, the cheapest is Google. That's why it's our #1 position. The next cheapest are NVIDIA and Meta, even though Meta's up so much this year. And NVIDIA's up so much here because the earnings have simply exploded. And Jeff and I were talking about NVIDIA yesterday. We have NVIDIA. It's a smaller position, only about 2% in our portfolio. But, you know, they tend to guide higher when they release earnings. So when they announce earnings in a couple of weeks, the real debate is, will they guide higher for the next quarter, which they're on a January quarter, because they're going to have to take into consideration that, you know, the Biden administration has banned them from selling chips to China, and will they be able to substitute or repurpose the $5 billion of revenue or so that was supposed to go to China to some other country, whether it be, you know, Norway or Mexico or whoever else wants to buy AI chips. And I think the thinking is they will be able to do that. So the last couple of quarters, they've guided higher for the following quarter. It's always the guide because they always guide to the next quarter. If they can guide to I think it's 17.7 is their revenue for the fourth quarter. If they can guide to say 20, the stock will go higher from here. And, you know, so from a revision standpoint, it's positive. From a valuation standpoint, it still looks pretty cheap to us. It's about 25 times next year's earnings, so it's cheaper than Tesla. But you know, it's doing great from a growth standpoint. And then the most expensive stock is Apple. We started the discussion with Apple. I don't know what you guys talked about, but they cut their estimates. It'll be 5 quarters in a row with either negative or you know, zero growth, and yet it's trading at almost 30 times earnings. So, you know, when I look at, I get 9% long-term growth at 30 times earnings. I don't have any. It's not attractive to me from a valuation standpoint. That's why we don't own it.
Okay. Well, thank you very much. So you guys, this is a show about Tesla. We got the best speakers, the most industry experts you can find. And then it's all show about investment. And you can see that we have very different investment philosophies. And, you know, there's something to learn here by listening to different people's and different approaches. Everybody's right in their own way. And, you know, that's why we have this conversation. Thanks, everybody. And thank you, Alexandra, for doing your deep dive that you do every once in a while. Appreciate you. See you guys. Thank you again. Gary, he runs Future Fund, and you can go to his website at thefuturefund.com. Thanks, everybody.
Thanks.
Bye.